Welcome to Academic Gain Tutorials. In this video, we will look into the differences between trading and investing. The stock market has two segments, the primary market and the secondary market. In the secondary market, buying and selling of originally issued securities take place. The participants of secondary market are classified as traders, investors and speculators. An investor invests money with a certain view in mind regarding the return, or the output generated. On the other extreme, trading is performed by the traders, with the aim of earning money. They have nothing to do with what they are purchasing or selling, all they want is to buy when the price of the security is less and sell when the price goes up, to earn a profit. So, let's look into the basic differences between trading and investing in a tabular form. Difference number 1. Trading alludes to a system of transfer of financial product facilitated by the stock exchange in which the seller transfers stocks to the buyer for a price agreed upon by the parties. Conversely, investing refers to the act of keeping the money to work on various investment avenues to grow money over time. Number 2. The time horizon for holding the security for the trading purpose is short term. On the other hand, when money is invested in a project, then the time horizon for holding the asset is comparatively longer than in the case of trading. Number 3. In trading, the trader does a technical analysis to analyze the securities and forecast their trends in future, by the data obtained through trading activity, as against, in investing the investor has to perform fundamental analysis to analyze the project, plan or product, to estimate its intrinsic value. Number 4. Trading is more about day-to-day trends in the market, whereas investing is related to the long-term profitability potential of the plan or scheme. Number 5. Both trading and investing rely on future trends of the market, and future is uncertain. However, the risk factor is high in case of trading as compared to investing. Number 6. When it comes to trading, regular continuous tracking of stock is required to prevent loss. In contrast, investing requires an active watch by the investor to earn a profit when the market is up. And, difference number 7, trading attracts short-term capital gain on selling of shares on which tax of 15% is applicable. On the contrary, if the investment is held for more than a year by the investor, then it is not taxable. Otherwise, it is taxable. At the end of the day, both focus on making money, but there is a difference in that, in trading, the trader wants to generate income by buying and selling securities. As against, in investing, the investor aims at creating wealth by putting money in those plans and schemes that are able to yield a good return in future. So, these are the differences between trading and investing. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.